initial periods, eventually when the market does turn, we can see we are buying shares very cheaply. Hello everyone and welcome back to Statira Trading. Today we're going to go over a very powerful tool with its more conservative approach to investing / trading, and that is dollar cost averaging. Now, this is a strategy that's not new and has been around for many decades, but lots of people have used it as it's a very successful way of investing or trading, as it keeps the risk low over a longer period of time. So without further ado, let's jump into the theory behind it and explain it to you. So what is dollar cost averaging? Well, in its simplest form, it is splitting up your investments over a period of time rather than putting it in a lump sum. And over that split up, it will be the average of those buy-ins. Now, this is a strategy that people use because in investment or even trading, sometimes or most of the time, it's almost impossible to call the tops and call the bottoms in the market. So that's why people just put in a certain amount every week, month, or quarter, because it does not matter what price you get in. It is the average of over how many installments you put in. So if that doesn't make sense, let me give you an example. Okay, so for the example, I'm going to use the US 30, which is the Dow Jones. So the concept of dollar cost averaging is buying in every so often at the same investment price. So say we want to invest $100 a month, that means every month or every quarter we invest $100, meaning that the price every single month will be different. What this is to achieve is to try and achieve a lower drawdown, not trying to time the market, but also steadily increasing our position within the stock market. So let's just have a look at this period, for example. Let's give a perfect example of, let's go to Friday, October 1999. This, at the end of this month, is when we start. Okay, so say we put a lump sum in here, it would take roughly 2,376 days of complete drawdown until we get back to the break-even point. Now, that is one of the problems with a lump sum when markets are not performing, and this is where dollar cost averaging comes in. You see, this is just every bar is every 3 months, and every 3 months we're buying in at a different price that is considerably lower than our lump sum. And although this might not be making us a return in the first initial period, eventually when the market does turn, we can see we are buying shares very cheaply. So at one point, this would be down, the peak of 37%, meaning that we're buying shares 30% cheaper than the lump sum. And what this does is eventually, if we remember when we get back to that lump sum break-even stage, we would have regularly bought in and have a significant amount of shares compared to our lump sum value. So let's say we had a lump sum of 100,000. Well, we can see it takes several time to get there, but every 3 months we put in 5, so that's 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, 90, 95, 100. So at this point is where we stop investing because we've eventually scaled in our full position within the stock market of the allocation of £100,000. So this is where we stop right here, but every single one of these bars is cheaper than our lump sum value here. So this is the power that dollar cost averaging can have, especially when markets are trending. Now, unfortunately, when the markets do consistently go up, dollar cost averaging doesn't perform as well because we don't know when the market will turn at any point. We don't know if the market's going to constantly go up. So let's take an example here, for instance. Let's say we put our 100,000 in here. Well, the market only goes up. So this will be a bigger return than if every 3 months we are scaling into the position, because every 3 months we'll be buying less shares than we did here at a more expensive value. This is just one of the cons to dollar cost averaging, but what it does allow you is peace of mind when getting into an instrument, whether that is within the stock market, within like a fund, within the S&P, within anything, to be fair. And one thing that we do ourselves here at Statera, Jacob and I, we also use dollar cost averaging when it comes to our own algorithms. So we know that not every month is going to perform well. We know there's going to be down periods. So we want to take advantage of those down periods. But we don't know when these will occur, so there's no point us just waiting for that opportunity. So we invest it regularly every single month or every single quarter, depending on how much capital is available. And you can do this too. We have an algorithm that you can use a dollar cost averaging strategy with, and it is called Sequenti. Anybody can lease it, but there is limited spots. If you are interested in this opportunity, then you just need to visit our website, stateratrading.com. From there, you'll see that you can lease this system, and historically, it has beaten the S&P over 15 years of data. Now, if you don't think algorithms are the right fit for you, we do have an assessment tool. And from that, you'll be able to gauge whether our algorithm is the right fit for you if you have any concerns. It'll also tell you areas that you need to improve on. So then further down the line, you can come back and potentially use our systems later down the line once you have a better understanding. But that's just one of the opportunities that you have out there. You don't need to use our system. You can use dollar cost averaging across any instrument, whether, as I've said, whether that's stock market, property, anything, because at the end of the day, it's a very good strategy for consistent gains. What it does do is it reduces your downside, but sometimes, in this case here, it reduced our upside. But again, that is just a very lucky situation, because we could plot this anywhere within this down period. You could start dollar cost averaging here, and you will get multiple months under that value, and you'll get a lot more shares at a cheaper price. You can pick probably anywhere in the charts, and you will find that dollar cost averaging can be very effective. Let's jump back to the slideshow and let's discuss some more things within that. So to round this video off, let's just go over the pros and cons over the dollar cost averaging strategy. So first of all, let's go over the pros. You don't need to time the market. Like we discussed, if you've got a plan and you just gradually get yourself in, either month on month, quarter on quarter, or year on year, you will find that there'll be lots more benefits to that. You'll have peace of mind, and you don't need to do timing of the market. Hand in hand, in a bear market, it can reduce your drawdowns. This is because rather than lump summing, like we discussed at the first point, where it could take a year or two before we get back to break even, you will be buying at different prices all the way down. So this means in underperforming periods, you get more for less. Hand in hand, when the market does start to perform, or whatever you are dollar cost averaging in, you'll have more shares or more for less, meaning your returns will be bigger over the long run. Now, the only con to dollar cost averaging is, well, when we're in favorable conditions. So when we're in a bull market and we're just making higher highs and the price is just going up, that means that you'll be buying every single month at a more expensive price. But again, it is no worries at all, because we don't know when the market could drop. It could drop at any point, and then we get our favorable conditions. But in some cases, a lump sum will be better than dollar cost averaging if we are just in a constant bull market. But we will never be able to tell whether that's going to happen or not. So the best solution, if you want peace of mind, is definitely dollar cost averaging. So that brings us to the end of this video. I hope you have a better understanding of what dollar cost averaging is, and now you know how you can apply it to whatever way you want to invest, whether that's the stock market, our algorithm, or any other investment area. Now, if you've enjoyed this video, please give it a like. And if you want to see more educational content, then hit the subscribe button and a notification bell so then you're notified when we next upload. But until then, I hope you have a great day and we'll see you in the next video.